Hello, world. Welcome back to my channel, where we offer clear and practical advice about business and personal finances without the jargons. Make sure to hit that subscribe button and check out our blog site where we post every Monday, Wednesday, and Friday. Today, here at JMC Accounting, we are talking about what is a financial plan. Think of a financial plan as your Google Maps, your Waze, or your Apple Maps for your money. It helps us to understand where we are currently financially and how to reach our financial goals in the future. Remember, back to our talk about the 50-30-20 rule, where what are our needs? Those are our expenses that we have to pay for in order to survive. Some examples are rent, food, utilities. This should comprise about 50% of our monthly budgeted expenses. What are our wants? Those are the expenses that we don't necessarily need, but they make life a little bit better, such as a gym membership, dining out, monthly streaming subscriptions, and this should comprise about 30% of our monthly budgeted expense. So the first thing we're going to want to do for our financial plan is to get a good current financial snapshot of where we are right now. This includes our monthly, bi-weekly, or even weekly, depending on how you want to break it down, income, expenses, your assets, your debts, and your savings. It's the starting point for understanding your overall financial health. And you don't need any fancy apps or anything like that. You could just use simply Microsoft Excel in order to create this plan. And that's what we did here today. So, the next thing we're going to do after we understand our financial snapshot is we're going to want to set our financial goals to help us. Like I said, it's our roadmap to get us to where we want to go. So, the first thing we want to do is we're going to go into our goals and we're going to set some goals up. Already in here, we have our college fund. We have a new home we want to buy, and we have our cars. And you can set your goals in a category of long, mid, and short. Short would be anything under a year, mid would be anything between 2 to 5 years, and long would be anything over 5 years. So for our person here, we have a college fund, probably for their kids, which is their long-term goal, a home they want to buy in the next 2 to 5 years, and a new car they want to buy within the next year. So their target amount that they want to buy their cars at 40,000, home of about 500,000, and their college fund of 100 million. And their current savings toward that goal right now is 10,000 for the college fund, 5,000 toward their house, and 15,000 toward their car. And then they have the target payoff dates, or the target execution date. And then we have where we're at and what our progression is toward our goals and expressed to us in percentages. Next, we're going to move on to our budget and savings. So all this means nothing if we don't actually look at and plan what our actual budget is to our actual expenses and income. So your plan should outline how much you'll spend, save, and invest each month to stay on track. So in here, our person, their income, they plan to make $1,000, but they actually made $800. So we have a $200 difference between our budgeted and what we actually did. And then for housing, it looks like their rent or mortgage payment is $300. It looks like we actually met our target. And then in our utilities, we plan to spend about $100, but we only spent $50. So we're saving $50 right there. So, and then food, so on, we plan to spend 50, but we actually ended up spending 100. Looks like someone didn't meal plan on the budget. So we're over on our food expense by $50, and so on and so forth. And then what's also cool is we have a pie chart over here that breaks down where our actual income to our expenses and where that stuff is going. And then it's shown again in bar form. Next, we're going to talk about debt management. We need a strategy for paying down those credit cards, loans, and other debts in a more manageable way. So in this spreadsheet, it shows us what our credit card debt is, if we had a car loan, student loans, and mortgage, and it gives us our balance, our interest rates for those different items, the minimum payment that we must pay, and if we're able to afford any extra payments, we're going to put them here. And then it gives us an estimate the months to pay off. So if we take a look at our credit card, we have a $25,000 balance, 13% interest rate. Our minimum payments a month is $650. If we only make the minimum payment of $1,600, it'll take us about 19 months to pay this off. But let's see if we make more than the minimum payments. Let's double it to $1,300. As you can see, it will save 6 months worth of interest, putting more money back into our pockets because now it'll only take us from 19 months to 13 months to pay off that interest, which really can pay big dividends when we're thinking about it. Next on our list is our strategy for building towards retirement. We want to build enough savings to support our lifestyle after we stop working. So, what do we have going on here? What we're going to do is we're going to put in our current age. We're going to put our retirement age. It's going to take a subtraction to see how many years till our retirement age. Our current person is 30. They're looking to retire at 65. And it looks like it's going to be about 35 years until they reach that. They currently have $20,000 saved in the bank, and they're contributing to their retirement account of about $6,000 with an expected growth rate of about 6% over that time. So their projected retirement is about $500,000 currently. And then we have our chart over here that shows us our progression and where we are and what our projections will be if we stick to the course. Now, there are some other things that aren't on here that we must go over, such as investments. This is a plan for growing your money through investments such as stocks, bonds, and retirement accounts based on your risk tolerance and your timeline. Next, we're going to talk about risk management. This includes insurance, such as health insurance, life insurance, disability insurance, to protect your finances from the unexpected events. The one event that we all know is not going to be unexpected, we just don't know when our time will be, is death. I would recommend that everyone gets life insurance for their family, especially those with children and those that have a spouse. You don't want that put that financial burden and stress on your loved ones after you pass. They'll have a sense of appreciation if you take out life insurance and policy enough to cover your expenses while you are not here. Another big thing, part of our financial plan, is estate planning. This is for individuals with the means of planning how your assets will be handled or distributed after your demise. For business owners, this includes a succession plan for how the business will continue once you choose to step down and retire, or even, again, after your demise. So, creating a financial plan can be simple. You just have to make sure you're staying consistent, realistic, reviewing it regularly, and adjusting it when your life changes happen. You don't need a fancy app. You can just use a spreadsheet or work with a financial advisor if you feel more comfortable in that sense. So, what's the bottom line here? A financial plan isn't just for the wealthy. It's for anyone who wants control over their money. It's your personal guide to making smarter financial decisions to build a secure future for yourself. Well, this will do it for this video. Hopefully you have a better understanding of what a financial plan is and how it can help your personal finances. Make sure to follow us on Instagram at JMC_accounting and to hit that subscribe button. And check out our blog site for the latest posting. I'll see you next time to break down the understanding of the W-4 withholdings form. See ya!